All right, let's continue our conversation on dividends. So what is a dividend? Well, a dividend is a distribution of profits to shareholders, right? The company makes money, they want to then share with their owners. It's a dividend. Now, most of the time it's a cash dividend, right? And it's only paid to outstanding shares of stock, right? Remember we talked about if you rebuy your own treasury stock? Well, it's in the corporation's hand when they repurchase treasury stock. So they're not going to pay dividends to the stock that they have in their hands. They'd be paying it back to themselves. That doesn't make any sense. So it's only paid to outstanding shares of stock. Typically, you're used to seeing a cash dividend. That's pretty much your norm, right? Cash dividend is $4 per share, 25 cents per share, whatever the number might be. A stock dividend, though, if a company didn't have the money to pay out a cash dividend, but they still want to reward their shareholders, they can elect to go with a stock dividend. So let's say you've got, 4 people with 10 shares of stock each, and you decide you're going to give them a 1-share stock dividend. Well, you know what that means? That means they have 11 shares of stock now. It doesn't mean a whole heck of a lot, but you still feel like you're rewarding your shareholders for, being with you, being part of your company, and they feel like they got something too. All right. So if a company can't do cash, stock dividend is a way to reward the owners. All right. Let's talk about the major dates that are involved with dividends. All right. So these are the 3 major dates we're going to cover here. We'll go through with an example. On September 1st, Dixie Corporation declared dividends of 20 cents per common share to stockholders of record as of September 15th, payable on September 30th. Okay, so a lot going on here. There are 500,000 shares of common stock outstanding, no preferred stock. So the first date we're going to talk about is the date of declaration. That's the date they say, we are going to pay dividends. And we're going to pay dividends to anybody who is holding the stock on September 15th. And the actual money, the dividends that we're going to pay out is going to be paid out on September 30th. You'll get the cash at that time. So the first thing is the date of declaration, September 1st. Date of declaration, well, oh, sorry, forgot I had a timeline. There you go. Okay. You're going to be paying out 500,000 shares of stock and 20 cents per share. And yes, they usually do pay like that. 20 cents per share. So unless you have a couple of shares, it doesn't really necessarily pay out much. Okay, September 1st comes along. We declare it. So we have a debit to dividends for the dollar amount, and we've got a credit to dividends payable. Because now that we've said, hey, there's going to be a dividend, we have now created a liability for ourselves as a corporation. So we have to record that liability. And it's not going to be paid out until the 30th. All right? So the day we declare the dividends is the date of declaration, or declaration date, however you want to say it. September 15th is our next date. That's the date of record. The date of record says whoever is holding the stock on September 15th are the ones who get this, are the ones who are going to write the dividend to. It's really an administrative date. There's no journal entries, but the company has to know where they're sending their checks. Where's the 20 cents getting sent to? So it's as of the people holding it on 15th, these are the people getting paid. Okay, no entry. Date of payment. Well, we had a liability. Now we're going to pay off that liability. So we will debit our dividends payable, credit cash. That's it. I do have, that's really the 3 major dates. I do have the closing entry here. It's not, we covered it in chapter 4, but we'll just kind of hit it again very briefly here. Remember, when you have a closing entry, how do we close dividends? We close dividends directly to retained earnings. So we debit our retained earnings, credit dividends to close it out. Because dividends carries a debit balance, we would credit it to zero it out, and it reduces retained earnings. All right. I am going to show you this one, accounting for cash dividends, just because I want to show you how it works with the preferred stock and the dividend amount. So we have Java Company earned net income of $85,000 during the year. They're telling you that because they want you to know that they're paying from the earnings that they made. They're paying dividends out of their earnings. On December 15th, they declare the annual cash dividend on its 4% stock, par value $120,000, and the 25 cents per share cash dividend on its common stock, 50,000 shares. There's a lot of information in there, so let's take it apart a little bit. The first thing we need to look at is the declaration date. We have to know how much, though, the dividends are going to be. So when they tell you it's 4% preferred stock, par value 120, they mean 4% times 120,000. If you look back to that example with the $4 one that I had there on the previous video, I think, it is that second example. you're taking the percentage times the par value. So that's $4,800 in dividends that have to be paid out to preferred shareholders. And they're also, so there's your dividends payable, preferred stock, $4,800. And you're paying out 25 cents per share to the common shareholders. So 25 cents per share, 50,000 shares, is $12,500. So you've got dividends payable, common stock, $12,500. And a debit to dividends for $17,300, which is just the two of them together. Date of record, you don't have to do anything. Payment date, you're just paying off that liability there. Okay, so I just wanted to show you really this part of it. So this way when you go to do your homework problems, you see, you have this to refer back to. All right. So let's talk about cumulative versus non-cumulative. There is cumulative preferred stock and there is non-cumulative preferred stock. Cumulative preferred stock says, all right, in this case it's $4, all right, there's a $4 dividend. Let's say you have one share of stock, $4. We say, all right, we're going to pay everybody $4. But what if the business doesn't have the money? What if they just literally cannot pay the $4? They just do not have it to spare. If that's the case, if it's cumulative preferred stock, it carries forward to the next year. So if you couldn't pay me in year 1, in year 2, you now owe me $8. And if you can't pay me in year 2, year 3, you're going to owe me $12. That's the idea of cumulative preferred stock. The idea is that, maybe you didn't get a dividend this year, but it accumulates over time. Now, hopefully, eventually you get paid. Hopefully, the business can eventually pay you. Common shareholders have no such guarantees, none at all. Common shareholders, if they get paid, they get paid. Good. But preferred shareholders get their money first. So let's look at an example with this. The corporation declares dividends as follows, 2015, 2017. You should probably update those dates, right? The company declares $14,000 in dividends in 2015. Okay, well first we have to figure out how much the preferred shareholders are supposed to get. Well, they're supposed to get $2,000. Let me move over a little bit. Kind of still in the way. There we go. You're supposed to get $4. There's 2,000 shares out there. So really the preferred shareholders are supposed to get $8,000 per year. So the preferred dividend then would be $8,000. They're going to get, of this $14,000 that has been declared by the company, $8,000 go to preferred shareholders. The common shareholders get whatever's left. So in this case, they get $6,000. Now, if you look at your dividends per share, which is an important number, especially if you're looking to invest with a company because you're hoping that they pay you dividends, you want to know what is the return on your investment. So you want to know what are you earning for every share of stock you have out there. So the dividends per share is $8,000. Oh, I should have the numbers there. It's I do. There we go. $8,000, right, of dividends divided by 2,000 shares. There's your $4 a share, which is what you expected them to get. The common shareholders is $1.50, which is $6,000 divided by the 4,000 shares of common stock. So they get $1.50 per share. Is that good? Is that bad? I don't know. It depends on what you're looking for with your investment. At least they're paying out something, right? All right, so let's look at 2016. 2016, they only have $6,000 that they can pay out in dividends. So if that's the case, the preferred shareholders are going to get their $6,000. They get paid first, but they're really supposed to get $8,000. So now they're owed, because it's cumulative preferred stock, the $2,000 they didn't pay them. Common shareholders, guess what they get? Nothing. They get whatever's left over, and if there's nothing left over, then that's what it is. All right, so we do our little calculation. We've got $6,000 in dividends divided by the 2,000 shares. It's $3 per share. Common shareholders, nothing. All right, 2017 comes along. They had a good year, $36,000. Well, the preferred shareholders, because it's cumulative, they get the $2,000 that was left over and not paid from 2016, and they get the $8,000 from this year. So they get $10,000 in total. Common shareholders get whatever's left, so it's $36,000 less the 10, they get $26,000. Preferred calculation, we'd have $10,000 divided by the 2,000 shares, which is $5 per share. Common shareholders get $26,000 divided by 4,000 shares. They get $6.50 a share. They had a banner year. All right, so the idea here, cumulative preferred stock and preferred shareholders get paid first. Okay, I'm going to stop us there.